Your time this afternoon. Just a quick disclaimer that all signals and trading opportunities provided both orally and written or electronically are for educational purposes only, and we are not certified financial advisors. We always recommend consulting a financial advisor prior to making any trading decisions. The risk of trading futures, forex, or stocks is high. And what I'd like to do today is introduce you to our market profile 2.0. And it's really going to show you how to find low risk, high reward trading entries on the futures, forex, or stock markets. Now, when you take a trade, it doesn't make any difference what kind of, we call them formations. You can have a candle, you can have a open high-low close bar, you can have a Renko. Every formation only displays 4 pieces of information: the open, the close, and the high and the low of that formation, and volume. So volume is the 5th piece of information that the chart provides you. And I think it's probably the most neglected parameter in taking trades, and it may be one of the most important. And I'm going to show you how our market profile provides you with really, really excellent trading entries. I'm going to show you the entries that I took today, which really respected market profile, and how it not only gets you into winning trades, it also prevents you from taking losing trades. It acts as a filter. It provides you with specificity at the expense of sensitivity and gets you into great trades, filters out the losers. Now, just a little bit about myself. I'm a graduate of the University of Pennsylvania. I'm a former professor at Jefferson College in Philadelphia, and I've published close to 15 peer-reviewed papers in first-tier journals, and I've been involved in the financial markets for over 20 years. And right-line trading is really the product of the mathematical analysis of price action, market structure, and indicator algorithms. And what my background is in mathematical modeling. And what we've done is break down the movement of price on any financial instrument into a series of independent variables. We've placed those into a multivariable equation, and via mathematical modeling techniques, we optimize them. And we come up with predictive software that has a really, really powerful ability to predict the future movement of price. And we are one of the fastest growing trading systems on NinjaTrader. Now, the problem with trading in the market, it doesn't matter what you're trading, whether you're trading futures, forex, or stocks, is that 95% of day traders fail. And the problem is that number never comes down over time. The 95% just remains fixed. And the reason that is because this is really a unique endeavor, and that it does not seem like one generation of day trader learns from the last generation of day trader, and that the process by which we use the trading techniques, and they don't undergo any kind of evolutionary process. That if we look at how day traders and swing traders were trading 10 years ago, they're using the same methods and trading techniques that we use today. They're using Fibonacci. We use Fibonacci today. Oscillators, MACD. I mean, nothing has really changed. And if you compare that to any other form of endeavor, whether it be architecture or medicine, if there was a 95% failure rate at the outset, and 95% of all the buildings that were erected fell down, or 95% of all the patients treated died, 2 things would happen. One, obviously there would be a big problem, but there'd be a scientific analysis of the reasons for the failure rate, and the principles and methodology that led to the demise of the patients and the collapse of the buildings would be modified. and slowly but surely the success rate would begin to turn around. That simply doesn't happen in day trading. And one of the reasons is there's no scientific analysis of this endeavor. I mean, if you do a Nexus Lexis search of the world literature, there's almost no formal studies that are undertaken, actually rigorous scientific mathematical studies to determine the predictive value of a signal off of any given indicator. So we just take a priori as being true, the same set of trading indicators, the same trading methodology. We trade momentum breakouts, or we trade off of Fibonacci support and resistance. Now these are, if our predecessors were incredibly successful, that would be great. We would be picking up a successful trading methodology and simply working right off of it to try to improve it a bit. But what we're doing is we're picking up their trading methodology, and it's led to an abysmal failure rate. So what we really have to do is we have to look at a new trading paradigm, a new way to day trade. If we do not discard all these failed trading principles that have been failing for over 15 years, we will not make money. I mean, all of the people, all of the traders who have really worked diligently to try to make money before us and have all gone bankrupt and busted out of the market, show us what lies ahead for us if we don't make a change in the techniques that we use to trade. So one of the ways to do that is to look at volume profile. It's a very, very powerful tool in helping you to day trade. It generates areas of support and resistance, and it's a critical and fundamental component to successful day trading. And if you look at support and resistance zones, you can get 75% of your trading entries to be winners. Now, I call these, core trading principles, and I label them secrets, but they're not real secrets, because I'm telling everybody here, the reason I call them secrets is they just aren't commonly respected, and they aren't commonly in use, but they have to be if you want to trade profitably. It's not voluntary, it's really mandatory. Now, the support resistance zones that volume profile creates with market profile are dynamic, and they must undergo constant adjustment, and you'll see how they do that. They have to recalculate intra-candle, and I'm going to show you why. And there's no formal zone of support or resistance as is indicated in a lot of programs. When resistance breaks, it becomes support, and when support breaks, it becomes resistance. So you use volume zones. You can use volume zones to show you when to pull the trigger and make money. And I did that today, and I do them almost every single day in our live trading room. I just want you to know, I don't look at questions till the end, but if you have any questions, feel free to write them down, and I'll answer everything at the end. Now, this is commonly the way you see volume profile. And volume profile is simply the distribution of volume over any given time period. And this is volume at price. Now, I don't know what specific trading instrument this is or what particular market it is. It's really irrelevant. But you can see the white line here is the point of control. And we're going to go into volume profile much more in depth, but in general, if you've seen volume profile, this is likely the kind of pattern that you're familiar with. Now, here's another volume profile. And from volume profile, we get distinct areas of support and resistance, which we must respect if we want to trade profitably. We cannot trade into an area of upside resistance based on volume profile, or we're likely to get a loser. What we're doing in day trading is to minimize risk. And when we trade into one of these areas, we take enormous risk on a trade. So this is our volume profile. Now, we've adjusted it quite a bit since I made this slide. But essentially, all it's showing us is the volume that's crossed on a trading instrument at any given price. It's a volume distribution. So if you've ever heard of the three words VOP, or volume at price, this is the distribution of volume. Now, why do we know that this has mathematical relevance and is going to help us trade? I don't want you to take anything as being valid simply because I tell you. I want to show you the mathematical validity behind the principle of volume profile. Now, volume profile is based on really sound math. If you take the distribution of any amount of data in a closed system, in a perfect world, it would be normally distributed, and it would look like this bell-shaped curve. And in a normally distributed set of data, like volume, in a perfect environment, this black line, it's a little hazy, is the mean price. And surrounding this mean price is a standard deviation of volume. And that standard deviation creates what's known as fair value. And price is traders desperately want to keep the price of this instrument within this fair value zone. Now, we don't live in a perfect world, and so the data is not normally distributed. But this is the scientific principle behind which volume profile lies. Now, the point of control is the mean price for data that's normally distributed. And it is the price at which most volume crosses, and it's the mean price of all the volume distributed in this curve. The value area high and value area low encompass those 66 2/3% of volume around the point of control. And as I mentioned, traders in this auction environment want to keep the price of this financial instrument below the value area high and above the value area low. Now, this is our market profile. It's not all the information displayed at once, but this is what you're going to see when you look at our volume profile. Now, I purposely minimize the size of the histogram in order to very clearly display for you the value area high, the value area low. These are these two magenta lines, and also the point of control, which is this black line. And what I wanted to show you was that if this data was normally distributed, then the mean price or the point of control would be located around this blue line. But you can see the data is not normally distributed, but it doesn't make the derivation any less valid. Traders want to keep price in between the value area high and value area low. So these are the kind of forces that are coming to bear on price. And these forces are created by us, by not just us as retail small commercial traders, but also by institutional traders. Here is 66 2/3% of all volume, located between the value area high and the value area low. Again, I just want to point out, here's the VAL, here's the VAH, and here's the point of control. So now, what happens, as price moves? As it gets to the value area high, the price is going to be repelled because traders want to keep price in this fair value zone. when it gets to the value area low, it also is going to be repelled. Because again, traders want to keep price in this fair value area. Now, the point of control is the price at which most volume has crossed. So while the VAH and VAL repel price, the point of control attracts price. That's the price that traders are most comfortable trading this financial instrument. It happens to be crude, but it can be anything. It can be a stock, it can be a Forex pair, it can be any futures market. The point of control at $53.49 is the biggest histogram bar, and it is the price that traders are most comfortable trading this instrument at, and that's where they want to push price to. So you've got the value area high acting as resistance as long as price is below it. The value area low acting as very strong support as long as price is above it. And you have the point of control also acting as support or resistance as it pulls price back into it. Now, market profile is constantly changing because volume profile, which determines it, is constantly changing. This is the importance of having this indicator continually reformat market profile intra-candle. Most indicators don't. They work on a candle close basis. So imagine if you're trading a 3-minute and you think you're using the value area high as an area of support, at candle close, that value area high may disappear because volume profile has changed so much that the value area high is now shifted. This is what happens when your market profile formats at candle close. It must format intra-candle because every contract, every lot, and every share of stock that cross in some small way change this volume profile. So you want all of these values to be totally up to date when you set up for a trade. I mean, there's some traders that don't want to trade 4-hour bars. If you want to wait 4 hours to get a reformate or for a market profile to reformulate and change, you may get yourself into a lot of trouble taking an entry. Now, what we also calculated is that they're critical additional low volume nodes. Now, there are a number of low volume nodes on the chart, but there are only certain critical low volume nodes. And they're exactly the opposite of the point of control. The point of control is the price at which most volume has crossed. And the low volume nodes is price where almost no volume has crossed. So you can see how these areas are areas of resistance because price just does not want to move through them. So what we did is we found that we have zones of rejection. When the value area high and this low volume node become confluent, the software creates the zone, and the zone becomes opaque. When this low volume node and the value area low become confluent, you get this zone. Now, these areas are synergistic because they reject price for different reasons. The zone, the value area high, is pushing price down because it wants to keep price within this fair value area. The same thing for the value area low, pushing price up. These low volume nodes are rejecting price simply because there's no volume crossing at that particular price. Traders have decided they don't want to trade, in this particular case, the E-mini at 23.46 or at 23.40.25. So these areas become very, very difficult for price to move through. If price is above it, it's a strong area of support. If price is below it, it is a very strong area of resistance to the upside. So you can trade off of it if it's broken, but you don't want to trade into it because of how powerful it is as support and resistance. Now, here's what a lot of indicators like this do. They create fixed areas like this, where red is indicated as a zone of resistance and blue is indicated as a zone of support. And these track across the chart. But the only place that these zones are actually active is on the right edge, because the right edge of the chart is the only place that market profile is accurate based on volume profile. I'm going to show you that more. You cannot create this fixed zone of support and resistance based on volume profile. Now, we take this a step further because volume is complicated and it gives us a lot of ways to leverage it. Now, unfortunately, in this slide, I don't have numbers, but above every single candle, you get a delta. That number tells you whether there was an overabundance of buyers or an overabundance of sellers sitting on your dome, on the buy-sell side, on the bid-ask side, for every given tick of this candle. And the market delta creates a line on your chart telling you whether there's buying pressure or whether there's selling pressure on the chart. And you always want to trade in the direction of that buy-sell pressure. What I found is if you just try to track these numbers, it really, really is very difficult to tell what's going on. So what we've done, now this is off of our own trading chart, and you can see these zones here, and you can see this zone here. It's a little bit obscured. I just took this 20 minutes ago on the E-mini, and you can see price coming up to resistance, tries to penetrate, and then it gets rejected. And price was heading off of resistance the last time I looked. Now, the only thing that I really want you to look at here is our right line delta. You can see when the line is green, it means there's more traders looking to buy than looking to sell. And when the line is red, there are more traders looking to sell than they're looking to buy. Now, we don't store this data, and NinjaTrader doesn't store this data. So every time that we close our NinjaTrader and reopen it, the line starts over again. So I have to open my platform around midnight. So when we start trading it around 9:30 in the morning, we have a nice long market delta profile. But this is how it looks. Whoops. Now, we also want to look at buy pressure and sell pressure on your two higher time frames. And this is one of the most powerful indicators because there is no other market profile that does this. So what we did was, and I'm going to go back, we took the market delta on the two higher time frames and we created a moving average. It's a 15-period moving average of the delta. And what it tells you is when there's an overabundance of sellers on your two higher time frames, this data, and this is called our order flow indicator. When order flow shows an overabundance of sellers, and now I just want to preface this with, this line does not use any data off the trading chart. It only uses data on the two higher time frames. Now, if you're trading a 5 range, it defaults to the two higher fibs. It goes to the 8 range and it goes to the 13 range. If you're trading a 8 range, it goes to the 13 and the 21 range. If you're trading a 377 tick, it goes to the next higher fib, which is a 610 tick, and then the next highest fib, which I think is a 987. If you're trading a 3-minute chart, it goes to the 9-minute chart and the 27-minute chart. So the indicator algorithm automatically determines your two higher time frames. So what it does is it's looking at the moving average of the delta of the two higher time frames. When the line is red, there's an overabundance of sellers on both your higher time frames. When the line is orange, there's an overabundance of sellers on the longest term time frame. And the longest term time frame always rules. So we always trade in the direction of the longest. We like to trade in the direction of the two longer. When the longest term time frame has an overabundance of buyers, it's green. When only the longer term time frame has an overabundance of buyers, it's blue. And what it does for you is create a strong directional bias. If you try to trade in the opposite direction of order flow, there's a very high likelihood you're going to take a loser. And what you want to do is avoid risk. So trading in the direction of that signal or in the direction of order flow and not try to counter trend trade against order flow will really reduce the number of losing trades you have and increase the precision of the entries when you trade in the direction of the higher time frame order flow. Now, right now, it doesn't show you the delta on your trading chart, but it's likely that if your two higher time frames are to the upside, your trading chart will be to the upside as well. I'm going to show you that in the last few slides. Excuse me, we're going to put it all together. But this order flow indicator, I think, is unique. Now, we also have a volume ladder. And if you'll notice, I don't want to come off. I'll just show you this real quick. I'm going to drag it in front of the screen. You can see that in the candle, we show you whether there's an overabundance of buyers. Here it's all red. So there's an overabundance of sellers on this tick level. Here there's an overabundance of buyers at this tick level. So you see if there's a buy-sell imbalance at any given tick level. Now, it's very commonly misused. It does not give you, it will never guarantee you that you get a continuation trade because it's constantly in flux. The way it should be used is when there's an overabundance of buyers at this tick level. When price comes back around, there's a lot of buyers sitting here. And so it's going to act as a weak area of support. If it breaks, you've got an overabundance of buyers here, and you've got another weak area of support. So again, it increases the precision of your trading and helps you define risk. But if you get a massive overabundance of buyers at the top tick of your candle or the top penny of your stock or the top pip of your Forex, it doesn't guarantee follow through on the trade. You just have to be concerned when price rolls around and comes back. And this is oftentimes known as where there are hidden areas of buyers sitting intra-candle. Now, I wanted to show you two trades I took today in our live trading room. This was a trade I took. I had to put this in because remember, this zone is only present on the right edge, and the right edge is now all the way off to the right. This was a 17-tick trade I took on crude off support. Now, the delta is gone because I closed the platform, but you'll notice these lines. I was trading in the direction of multi-time frame order flow on a pullback to support and a continuation long. 17 ticks on crude. The next trade I took in the live trading room, and there's our volume profile. There's our point of control. We had squeezed through it. We hadn't technically broken it, but I felt I had so much going for me on the trade, I felt we were going to move through it, and it did. Here was the other trade. These were our areas of support and resistance. These were our rejection zones. And at the time, the lower line is order flow. The upper line is multi-time frame momentum. It was a little bit of a risky trade, but I was trading the direction of order flow, coming back to support. And in this particular slide, you can't see, but this trade went 2.25 points. Those were the only two trades I took because we made really nice money on these. I didn't want to trade on. If I had, we would have had a lot of additional winners today. But I just didn't know that. And volume was dying. Then later in the afternoon, there was a lot of volatility. But leveraging volume profile and the direction of order flow is what helped ensure that these trades were going to be successful and made them low risk. So let's take a look at other trades. Just looking at market profile based on volume profile. Now, when this price comes up here and you want to take a counter trend trade, you can't, because order flow is telling you that there's an overabundance of buyers on the trade. So you can't take the trade in a counter trend direction. If you do, the chances are you're going to get stopped out. Now, this was a successful trade, but a successful trade doesn't make it a good trade. If you assume too much risk on the trade, you're more likely to get stopped out than not. So making money is irrelevant. And there are a couple of times this week in the room where I made money on very risky trades, and I told traders in the room, these were too risky. I made money, but I don't like the trades. The same thing with this counter trend trade. Order flow was blue. I didn't want to trade in a counter trend direction. Here's where you take your trade. Price comes up, breaks resistance, comes back to support, and you trade in the direction of order flow, and the trade goes all the way up to resistance. Moves right through the low volume node, right through the point of control, right up to this high area of resistance, and then falls. That's the low risk entry that you want to take. Always in the direction of order flow. Here's another trade. Come back to support, order flows with you, take the trade long. Come back to support, order flow is green or blue, you take the trade long. You come back to support, order flow is with you, you take the trade long. Now, from entry to maximum excursion is 31. I'm not going to say you're going to get all 31, but your probability of getting a profitable trade is extremely high. The probability of getting stopped out is exceedingly low. Those are the kind of trades you want to enter. And here is where you can take the reversal, because here's where volume profile has shifted. And now you're looking to short the market off of resistance in the direction of order flow, which tells you there's an overabundance of sellers on your two higher time frames. You're going to exit at support. So eventually price does break support, and you're going to wait for it to come back to resistance and then take a continuation short trade in the direction of red or orange order flow. There's another trade, and I wanted to show you this because you're going to miss some setups, and you can't always take a trade that evolves into a winner when the entry on your right edge is too risky. And in this particular case, price came back to support, but order flow was against you. The trade went, order flow changed, but on your entry, it's too risky to enter. And you have to step aside. You can't take the counter trend because order flow is green or blue. You can't take the counter trend because order flow is green or blue. Here's your counter trend. It's off of the resistance of the point of control, and this becomes a very low risk short that goes 61 ticks if you don't take it off more conservatively at support. If you're on a runner and you're willing to let the trade roll, it goes right through support. Now, there's something really important about these zones, and that is when they're confluent, like they are up here. when the low volume node is tight to the value area high, the zone is extremely strong. When the zone becomes wide and the low volume node separates from the value area low, then the zone becomes weaker. So you can actually assess the strength or weakness of the zone of rejection based on how confluent the low volume node is from the value area low or the value area high. Very powerful area of resistance here. Price doesn't break it. Very weak zone here, and price just smashes right through. And here's another trade. You break through resistance, and the reason I wanted to highlight this is a technical break of resistance is a 2/3 candle close. This candle, that's Japanese candlestick dogma. You need a 2/3 candle body close above an area of resistance in order to technically break it. This candle with the first blue arrow doesn't. If you want to take your entry one tick above, you're taking a more risky trade, but you're trading in the direction of order flow. If you want to take this candle that has a clean technical break of resistance, this is a very low risk, high probability winner. And that goes 27 ticks. Now these, I'm just going to go through a few trades that I took in the trading room. This is in the direction of order flow, on the move up, the retracement back, the continuation for 24 ticks. Now what I wanted to show here, hold on one second. But what I wanted to show here is when these zones become confluent and price gets sandwiched in between them, this is when you stand aside. This is when you don't trade, because you have to wait for a break of support or a break of resistance before you can take a safe trade. This is when you take your hand off the mouse and you wait for price to make a move, because there's no safe trade here. You don't want to trade up into resistance, or you don't want to, and you don't want to trade down into support. You just leave the trading alone, because these zones have become so confluent, there's no room to trade. Here's another trade in the direction of order flow. A move back to resistance and a continuation down for 18. A trade off of the support for 2.5 points up, always in the direction of order flow. Taking a trade against this direction is sort of a kamikaze trade. Now, these are two trades I just took recently. This is on 5/19. These two lines below are order flow. The move back on the right edge, up 7.5. The move back to support, look down, blue or green, and the move up for 2.5 points. 10 points on the E-mini, safely, always in the direction of order flow, which tells you there's an overabundance of buyers on this, in this market at the particular time you're taking a trade. And you can see intra-candle, the buy-sell pressure at any given tick level. There's another trade very recently in the direction of order flow. Pull back to support and a move up for 20 ticks. So we've got market profile, which is a manifestation of volume profile. We've got the value area high, the value area low, the point of control, the low volume nodes, create the zones of rejection, and then we've got the delta moving average. Now, before I go to here, I want to take this down. I'm going to bring over the charts. Now, here is our market profile in real time right now on the E-mini. Now you can see that there's very, very little volume. And what I really wanted to do was just show you, here's your delta. Let me spread this out a little bit. This is the buy-sell pressure on the chart. It's just going back and forth because this is really post-market. Here's the buy-sell pressure intra-candle. And again, it's so crazy because it's just at the market close. And you can see on the right edge of the chart, these are the active zones right here of resistance to the upside and support to the downside. And here's order flow on your 2 higher time frames. So your expectation here is to look for a short trade. That's the direction of the 2 higher time frames. It's a multi-time frame assessment, and also order flow on your chart, or the right line delta also tells you that there's an overabundance of sellers, and it gives you the magnitude. There's 3,305 more sellers than they are buyers. This is the absolute delta on the trade. And this is how, on the right edge, price behaved throughout the whole day. I'm sorry that I don't have the more data, but you see it only accumulates when I open the chart. So what I'm going to do is also, I'm going to put up our trading chart. So let me take this down. Let me show you the chart we traded today. Now here was the E-mini. And here was the trade I took long. If you look at the lower line here, I was trading in the direction of order flow. The delta was in my favor. You can't see it now, unfortunately, because of the fact that I closed the platform and reopened it. But the trade went up 9 ticks. I don't have it scaled correctly here, but if I scale it, we entered right here, went up to here. It actually went up 3.25. Now we were out of the trade earlier than that, but from entry to maximum excursion was 3.25 ticks, which is real nice. And it was a great trade here, system generated, but that was at night. Can't take that. Both of these lines are green, and we just can't take that long, obviously in the middle of the night. And let me show you the trade on crude. Here's my crude chart. The crude can be tough to trade. And there's a lot of volatility on crude after I closed the platform. And I didn't know that that was going to happen. But here was our trade. If you look at the right edge, there's support. There's the point of control where I've nosed through it. I've got green, green in the direction of order flow. Background color is good. And we went up for 17 ticks right here. And you can see we made nice money today. Really nice in a really, really tough market. 2 trades out, finished at 10:30 in the morning. Now now it's unfortunate that that the market delta doesn't store data. The order flow is stored because it's simply a moving average, and I've got information all over the chart here. We can look at other potential trades. See, the thing is, this is all referring back to an old contract date, so none of it is accurate. Right here is a terrific long trade. Now it's early in the morning, but you're getting a consolidation signal right off of support, and up you go. Here's another trade, and you can see in real time right off of that's the zone. That's the value area high. There's the low volume node. This creates this zone of support now. And there's this strategy entry, and up you go. So that, in essence, is our indicator. And I believe it's more of a trading system than it is an indicator. And just like it did for me today, if you respect it, it can make you very, very nice money. If you trade into these areas of support and resistance, they're going to really give you lots of problems. We never do it. And by respecting them, they really increase the precision of our trading, and that's what trading is all about. It's simply trading with the kind of precision you need to become profitable and to try to create an edge for yourself in trading the market that other traders don't have. Other traders are trading oscillator divergence. They're trying to call tops and they're trying to call bottoms. We're trading in the direction of order flow, the direction of market delta, and we're trading off of areas of support and resistance using market profile. It's a tremendous advantage, and it really will drive you to profitability. Now, let me just show you, let me just go back to the slides for 1 second. So I want to show you what we're offering you for the webinar special. I have to go all the way back down, I'm sorry. We're trying to offer you a lot. Now, the first 5 orders, we're going to give you 3 months in the live trading room. And that is a $399 value, and you're going to be in the trading room with me. I'm going to teach you our trading methodology. I'm going to show you how to trade, and I'm really hopefully will guide you into profitability. We make money in the trading room almost every day, certainly not every day. And if I represented that to you, you should click me out. But we make money almost every day. You're also going to get our 10-module weekly educational training session. Now, next week is module 3. We've already done module 1 and module 2. You'll get module 1 and module 2 on a link. And what we do is we teach you the foundations, the appropriate foundations for trading. The foundation with which that trading is based on is price action and is price action. And we learn how to read price action. Then we create price action and we add market structure. And then after market structure, we add indicator confirmation. And then what we do is something that almost nobody ever does. We teach you how to create an accurate trade management strategy. And I always see people saying, you know, I traded 1,000 shares and I made $8 million. Well, when they entered the trade, what was their stop? And what was their first target? What was their second target? And what was their third target? And what were those targets based on? You just can't take the trade from start to finish. You have to scale out. And the stop and targets have to be based on the math. You're trading a very, very volatile instrument. Your stop has to be fairly wide, but your targets can be wide. You can look for a really big run in the trade. I'm going to show you how to, what we're going to do is show you how to create a trade management strategy based on the math of the trading instrument. And people always say, you know, if I risk $1, I want to make 3. Well, you can't demand that from the market unless your trading instrument is volatile enough to give it to you. If you try to take more from the market than the volatility of what you're trading will allow, you're just going to wind up with a lot of losers. So from soup to nuts, we teach you how to trade. So, and we give you the market profile. Now, all of it together is like $29.96. What we're going to do is for the special, it's $799. We're only going to add the 3 months in the live trading room and the 10-module weekly educational training session to the first 5 buyers. And when you finish these 90 days, I'm telling you, you're going to see how to trade profitably. Because I trade profitably in the room almost all the time. And you're going to learn a completely new trading paradigm. You're not going to trade overbought. You're not going to trade MACD divergence, oscillator divergence. We're going to show you the right way to trade. And it is a very, very new paradigm, but it's based on mathematical modeling. And I'll just show you one more time. Now, let me just give you this is our rightlinetrading.com. Our email is info@rightlinetrading. And our number is 855-765-6681, and Rory will put all the links and everything in the room. But I want to take this down now, and show you our chart. I want to show you a full chart. And I'll show you crude. You can see that the only indicators that we use assimilate data from multiple time frames. We don't use single time frame analysis. If you do, it's useless. Our entry signals are based on multi-time frame analysis. This is a strategy entry. It's a complex entry based on the analysis of 3 time frames. The time frame we're trading and our 2 higher time frames. This is a trade out of consolidation, but this is our order flow indicator, and we respect market profile, which increases the precision of our trading. Here was a great trade off of an A candle. We just weren't in the market anymore. It was at 12:11, and we closed at 10:30 in the morning because we got our 2 quick winners. And we hit our profit target. Our minimum profit target is 200, and we were way over it. And then we got the 17-tick trade. And you'll see there's no oscillators here. There's no MACD here. There's simply the multi-time frame assessment of trend, order flow, and I didn't talk about correlative markets, but we assess that too. So I just want you to see the power of our platform. And you're going to sit in our room for 3 months. I'm going to teach you how to trade for 10 weeks. So that's our deal. And I hope you'll come aboard and check us out, because we are different. When I started looking at the markets, I never assumed that anything that I was taught or told was true. And what I learned was that 99% of what I was taught and told was not true. And I rejected it all, and that's why our indicators work off of multi-time frames, and most of them don't assess all the information that everybody else does. Fibonacci, we did a mathematical analysis going back 2 years, does not work. And it's a joke. Everyone loves it, but it's never made a trader profitable in history. Now let me look at questions. Okay, hang on, because there are a bunch. Okay, I'm sorry you left, Troy, because I could have answered all your questions. Well, okay, Brian, hold on a minute. I'll tell you what the background color represents, Brian, which is a very good question. I'll come off of this and I'll tell you what it represents, because it's a very, very important assessment that we use. Let me take the chart and I'll show it to you again. What it does is it's a multi-time frame analysis of trend. And I don't want to become too esoteric, but let me answer Brian's question first. We believe, it's my thesis, based upon, I know this is going to sound esoteric, but the market's like a closed system, and you can see from here to here there's no background bias. And you can see that the market is essentially moving in complete chop. There is no direction. Now, why does the market move in chop? And the reason it does is because, based on the law of thermodynamics, which may seem esoteric to you, every closed system in the universe wants to move to a state of maximum randomness. You have kids, and you look at their room, their room doesn't get neater and neater, it gets messier and messier. And the fact is, it's the same application to a closed system. If in the market, there is a tremendous desire for price just to move in random fashion. So what changes that? In physics, it's the application of energy. In the market, it's the application of institutional money. So what we look for is the application of institutional money to create a multi-time frame trend. And this multi-time frame trend is represented by background color. This is a power of the two higher time frames coming into alignment with your trading chart. Now, this is the second most powerful long color, but it tells you that you have order. Here's your weakest. The dark green color tells you that the market on your two higher time frames is now strongly to the upside. And what we are all about at Rightline is providing you with a directional bias. That's the power of order flow and the power of the delta. So when we get this dark green color, we are only going to trade long. And when we have no color, we believe that the market is moving in chop. And if you take a trade, you're going to trade with increased risk. And the role of software is to profile and give you a risk assessment. That's what its job is. It's to be able, it's for you to be able to assess the risk of taking a short trade or a long trade and tell you, look at the trade right here. Now you have the multi-time frame trend aligned to the downside. The risk of a short trade here is exceedingly low, and God forbid you should be these guys who are trading oscillator divergence and MACD divergence. They're counter trend trading almost every time they get crushed. And that's exactly what happened here. You got two green candles. We would never take them. They're counter trend to two higher directions. They're counter trend order flow. They're counter trend multi-time frame momentum, and bam, they're run over. Look what happens into this counter trend candle here. Bam, he's run over. Where are we? We're short. That's the background bias. And when it's green, now the market, the crude was really in a pickle today. And so I don't think we're going to see green. Let me move it across here. And I just want to get to a point where we're actually got information that's coming off of our. And right here, that was a 15-tick winner. That was a 9-tick loser. I'm not going to represent you. I don't take losers. But there's your trade. Now on the right edge, this is going up into resistance, so we wouldn't take it. But we have a directional bias. That's the background color. That's what's so powerful about it. And that's what it means. So hang on one second, because I got a lot of, let me just finish with one, then let me move on, Brian. The plus sign in the chart is the smart entry. It's called a strategy entry, and I'll show you what it does. We have a few system-generated entries, which are very, very smart. We just, they're just not indicator confluences, because indicator confluences will never make you profitable. And what the plus does is, let me show you. Because I'll open the back, I'm going to open the back of the chart view. If you take this right here, there's a plus here. And let me click it. Whoops. I'll open this up and I'll show you. It's called a strategy entry. And I know I'm getting a little bit off topic, and I hope I'm not boring people, but this is way past volume and market profile. But the strategy indicator is here. And we're trading an 8 range. And you'll notice it's set to a 13 range because it's assessing 3 time frames. The 8 you're trading, the 13's your second higher, and the 21 It's a multi-time frame assessment of market structure and price action based on this 2-2 setting. So when you get it, it's telling you that price is aligned in the appropriate direction, not only on your trading chart, but on your 2 higher time frames, and it gives you a very smart entry. Now, we can't take that entry because it's trading right into the resistance of the 50, but it smacks right through, although we can't make that judgment when you're trading on the right edge, but that's what the X is. And we look for system-generated signals because they're really good, but they've got to meet our other requirements. See, this is a counter-trend signal, and we don't trade counter-trend. We do, but we rarely do. And you will be amazed at how powerful the signal is when you get it. That's what the X is. And there's another one right there. Well, it might be the one I just showed. There's another one. And down you go. And in this particular case, you would take this signal because you're trading in the direction of order flow and multi-time frame momentum. And you've got pink background bias. So your higher time frames are aligned to the downside, and you don't have market profile to bother you with areas of support or resistance, and you get yourself a great short trade. So it's a really smart entry. That's what the X is. Bill, time starting point, it doesn't really. What it does is, our volume profile actually stores data. When you open up the chart on the volume profile, it does a proprietary look back period. Because if it just assimilates data from your trading chart, when you open it in the morning, it will not have accumulated enough data to provide you with a stable VAH, VAL point of control and areas and zones of rejection. I'm not going to tell you the number of days it looks back because it took us a long time to come up with that appropriate number. If you look back too many days, then the VAH, VAL, and POC become they're like a battleship. They don't turn. If they're too few days, then every time there's a big rush of institutional volume, the POC, VAL, VAH get pushed around. So this accumulates data from multiple time frames. So when you close and open, it's got the information in it. That's why the order flow information is here. But we didn't want to weigh it down because it uses system resources, but not too much, by storing the delta data for this line. And we could have, but we decided not to, because the more information we store, the more problems we're going to have in using up your system resources. So if you leave this open, it's always going to do that look back period of a certain number of days. And when you open it, it will always have that look back period stored in the indicator. So there's no discrete session start or discrete session end. Now, if you close it and leave it closed for a week and you reopen it, it's going to take a little while for it to reconstitute, but it's going to catch up pretty quickly. Tony, just give us a call. Not a problem with that. Now, it works on NinjaTrader, John. We're working hard to get it on Sierra, and in a couple of months we'll have it on NinjaTrader. I'm sorry, on TradeStation. It does do an ABC, and I call it my own. It's a little bit of a modified ABC. It's not because Elliott Wave does not work, but the ABC pattern gives you a great entry off a C candle. And I'll just tell you really quickly why that ABC is so powerful. And the ABC right here, this is a tough trade to take on this ABC because we're trading again below the 50. Now we are trading in the direction of order flow. It's a tradable entry, but we always try to exploit the traders who don't know what they're doing. And this B candle is a pullback candle. This is a red candle. I chose by default to make the B candle magenta. And when the B candle forms, you get an audible alert. And that tells you that you have the potential for an engulfing C in the trend direction, not the counter trend. The B is the counter trend candle. We want all the other traders to take the counter trend trade. And then what we want to do is to run them over with an engulfing candle in the direction of the trade. And part of what defines trend when we don't have background bias, remember trading without background bias is riskier, is multi-time frame assessment of order flow. If we're trading in a direction in which there's an overabundance of buyers, we have a much higher chance of getting a winner. We're never going to trade against that line. If we do, we're going to have trouble. And that's why the C is great, because when it does click in, it comes in with two forces. One, additional buyers come into the trade, and all of the sellers in the B candle get stopped out. And as they get stopped out, they have to buy contracts back to cover their short positions, and that stopping out process pushes the market up in our direction. And this is operational. I'm showing you the futures market, but it's operation on the Forex and it's operational on stocks. You want to try to run over someone in every single trade. And if you'll notice, so does our strategy entry. We're always looking to run over all these long traders in this candle. And that's exactly what we do. We run them over. And when we trade out of consolidation, nobody can figure out when there's a break of consolidation, but our software does on this triangle, because it does a multi-time frame assessment and come up with a really precise calculation of when consolidation will break. And this occurs intra-candle, and you can see it breaks out. This is only a 6-tick trade. Our first target's 5. We're going to get a first tick winner. But consolidation is great to trade off of because it traps these buyers. It traps multiple buyers in the counter trend direction, and consolidation almost always breaks in the direction of the trend, except when the market gets too oversold. That's all. So these are very smart indicators. There's a multi-time frame assessment to determine when is consolidation likely to break, and it gives you a great entry. Okay, I see. You know your question about CPU intensive, Rajesh. Ours is not that bad. Well, Diana, directional bias is 80% of being a successful day trader. And I am not overstating that. And that's why so many of our indicators simply are there to provide you with the appropriate direction to trade. When you're on this pink area, you would never take a long trade. When you have order flow, these are independent variables. This is the multi-time frame trend to the downside. This is the multi-time frame assessment of the delta. When you have these aligned, you're never going to take a long trade. You're simply going to look for a great short entry and then ride this thing down. Now, if we were in the market, I would have taken that A right here. We would have been in 1 tick below, and we would have gotten a 49-tick trade. Only, unfortunately, I closed. But because I know what direction I want to trade, I know that I am not going to take a long trade. And determining the appropriate direction is really, really a big deal. And I'll just show you one more thing. I'm really getting off topic, and I apologize to the people that I may be boring. But if you really want to understand the system, let me show you one other thing. These 3 lines, and this is not part of the indicator, but these 3 lines assess correlative markets. You know that when the E-mini goes up, now look at this trade. If you don't take this trade, you gotta resign and change your job. because what you have here is 5 greens. Background bias is aligned to the upside on multiple time frames. The system is telling you you're going to break out of consolidation on that triangle. Your trade is placed a buy stop 1 tick above the close. What are these 3 green lines? They're 9 correlative markets, and they're an indication of money flow. What goes up when the E-mini goes up? The Dow, the NASDAQ, and the Russell. And there's 9 markets in these 3 lines. What goes down? Treasury notes, treasury bonds, certain precious metals, certain currencies. What happens when this goes up? This is risk on. The institutional players are rotating their money into stocks. What goes on? So this goes up, these goes down. What happens when these reverse? Risk is off. So this trades the intersector rotation of money by the big institutions. Again, what does it give you? Nothing more than a directional bias. When you have these 3 greens and multi-time frame order flow and multi-time frame direction and a signal to break out of consolidation, I mean, honest to God, it's a back up the truck trade, because you're going to back up the money truck. This is going to be a winner for you. As long as you have the patience to wait for the setup, you've got the direction, you're seeing the direction of institutional money, you know the direction of multi-time frame order flow, the direction of multi-time frame momentum. I'm sure the market delta on our trading chart was in our direction, and up you go for a nice winner. And what we're doing, and I just want to point out, there's traders going short, there's traders going short, here's traders going short, going short, going short. They're all over the chart, and they all lose. And that's the traditional trading method. Oscillator divergence, MACD divergence, counter trend trading, calling tops off of magical systems that tell you they can tell when the market's going to turn. I will tell you when the market's going to change direction. And you know when that is? When the institutional money decides it's going to change direction. And it is not going to stop until the institutional traders decide it's going to stop. So as long as you've got 3 greens and they are doing an asset class rotation of money, and as long as they're creating a multi-time frame trend to the upside, counter trend trading is going to break your bank really quick. But you got a ton of traders, there's a nice little short trend, and boom, they get run over. Another counter trend, they get run over. Eventually, you got yourself a high, but only after getting run over 25 times on the chart. That's what our system looks to do. And the system gets you into great entries, because every entry is a multi-time frame assessment. It's not a single time frame assessment. And we always trade around order flow. We look at the right edge, and we make sure that we're not trading into a zone of rejection. And that increases our percent wins. Right here, because at the time, the zones were way at the top, and we had a free and clear trade. So I'm not giving you too much information. I never anticipated talking about these things, because normally when I give a talk on order flow, and I don't really talk about all of the other things that we have on the system to give us a trade. But this gave me a beautiful 9-tick winner today on the E-mini, and there was no other trade I would have taken, because the E-mini was trading right into resistance almost the whole day. And I think this really exemplifies how tough the zone is. It did get broken, but for the most part, price was either into it or below it. And there was no really low-risk trade. But the thing that's important is we knew the only trade that we're going to take is a long trade. We are not going to try to counter trend trade the market. Even though at the very end, after the E-mini close, we had order flow rotate to red. We had the delta change to red. At this point, there's no volume in the market, so we're just gonna, and we have a very unique volume indicator, but I'm not gonna go into that. So let me see if there are any other questions. It'll work on hybrid Renko bars. Correct, Brian. As long as the candles have a wick, it has to have 4 parameters in order for the system to work. It has to have a high, a low, and an open and a close of every candle. If it does, it'll work. If it's a standard Renko brick, it will not work because it doesn't have these 4 parameters. And the problem with standard Renko is a lot of people use them and they're deaf, because without these 4 parameters, most indicators don't function and you have no ability to read price action. As long as you have a high, low, open, close on every Renko, on every hybrid Renko, you are fine and the system will work. Market delta, Chris, is simply whether or not, I'll show you exactly what market delta is. If I close this a little bit, let me show you, because it's something that you need to know. No matter what you do, you have got to understand what the market delta is. And I'm sure a lot of people in the room do, but it is not a bad thing to show you again. If you look right here, there's 48, there's 1 trader at the ask, and there's 4 traders at the ask, and there's 1 trader at the bid. Now, in the course of a normal day, there are hundreds at the ask, and there are hundreds at the bid. And these numbers are constantly changing. Now, so the delta right here is 3, and it's a positive 3. There are 4 traders buying and 1 trader selling. So the delta is a positive 3. And it's telling you that there's more buying pressure here than there is selling pressure. If the market were open, this thing would be flying. And that's what this line is assessing right here on the edge. It's telling you, this is crude. It's telling you as crude falls, you can see crude got a little squashed here at the end, but it's telling you always an overabundance of sellers, always an overabundance of sellers. And that's what we're looking for when we want to take a trade short. So that's a very important concept. And this is the delta off the chart, and this is the moving average of the delta off of our 2 higher time frames. And the 2 higher time frames were choppy because this is the end of the session and volume here was very tiny. And you're not going to trade crude at after the close of the crude pit. And this you're looking at 3 o'clock, 4 o'clock, and 5 o'clock in the afternoon. But that's what we're looking for here. That's what the delta is. It's a very important parameter. You have to trade in this direction. Sure, Tom. Just give us a call. We'll do it for you right now. Not a problem. This is a great system on all the index equities, like the E-mini, the NASDAQ, the Dow, and the Russell. It's very powerful. Really, really will help you trade. But it also works great on stocks. I used to trade stocks in the afternoon until I started lapsing into a coma, because I would trade the Forex at 4 o'clock in the morning. Then I would close our room for like a half an hour, open it and trade futures, close it, and then open it and trade stocks. And I was basically becoming exhausted. I'm a single dad. I have a 16-year-old kid now, and I couldn't maintain it. So I just trade futures. But we're gonna look to start trading stocks again in the very, very near future, because let me tell you, we don't trade gaps and all that junk, because I think that is all a gimmick. That trade a gap. Let me just tell you one thing, and again, this is way off subject. A gap is a trade imbalance when a trade gaps at the open, it's telling you that there's a tremendous accrual of either buyers or sellers pre-market. So when the market opens, the stock is going to gap in a certain direction. After that occurs, everything is in flux. You want to trade with the multi-time frame trend. You want to trade with multi-time frame order flow. You want to trade with the delta. And I'll tell you, it's the biggest gimmick out there. But if you try to successfully trade gaps, you're not going to be able to do it. And all these people that represent that they make hundreds of thousands of dollars trading at the gaps at 20 minutes in the morning are just, it's ludicrous. You wait for the gap to establish itself and you trade it like any other trading instrument. We get crude inventory. I got a great trade off of crude inventory. It was a $290 trade. We stand aside because all of a sudden there's crazy movement. We let it settle down, and then we move in to take the trade when we have the alignment. No, we don't, Ted. We don't need to, because what I do is I let the data accrue from midnight. I open everything up. So we've got great data on the chart at 9:30. We've got a great delta. We've got order flow, which is stored, and we can take a great trade at the E-mini open. I don't like to trade the E-mini open, again, because there's a lot of instability, and traders are still trying to figure out what they're going to do, and I like to trade the open. And here was the open today. I stand aside when there's instability in the market, and I wait for the multi-time frame trend, and it happened really soon. We got it this morning at 10:06, and we got the crude trade just a few minutes later, actually earlier than that. And we were out with a huge, you see our profit, and we were out on 2 trades, and that's our chart trader. That number don't lie. So that was it. So, I mean, I wait for market stability and for everything to align, and that's when I move in, because I want to minimize risk on a trade. I don't want to take a trade when it's risky. My shortfall as a day trader is that sometimes I am unwilling to close the platform, and I trade on with low volume. That's the weakest point I have. Like if I'm up $70 for the session, I don't want to stop. And so I'll trade at 11:30 when there's hardly any volume crossing, and that always becomes a high risk trade. And I have to be very careful that I don't trade a low volume market. But when I have a tremendous amount of patience though, and I try to always adhere to our rules. Brian, that's a great question. How do we determine how to get out of the trade? And what we do is we know what the average true range of crude is over 2 years. So what we have is we have an automatic trade management strategy programmed into the trade. So let's say we trigger a trade right here. Automatically, the trade management strategy sets up 3 targets. The first target is at +5. The second target is at +10. And the third target is at +15. We're in with 4 contracts, and we optimized our exit. So we take our first 2 off at 5, and that gives us $100. We take our second off at 10, and that gives us $200. Well, can't do it. And we take our third, and it's not 15, it's 20. And we take our third off at 20, so we make $400 on the trade. And we've scaled that based on the average true range of the instrument. It's readily doable to get that 20 ticks on crude. On the E-mini, we take our first target at 3, our second target at 7, and our third target at 11. So everything is preset. So let's say you want to trade Google. You can come to us and we will tell you, like if let's say you want to trade 1,000 shares, and I'm just pulling that out of my hat, where to take off your first 333, where to take off your second 333, where to take off your third 333, so you can optimize your exit, but achieve a goal that's achievable. Not just decide you're going to take Google for 7 points before getting stopped out when it's unlikely to get that far. And what we do is we use the average true range of the instrument. I'm not going to put that indicator up, and we go back for 2 years, determine its volatility, and a market with a high ATR has a tremendous volatility. You got to set a little bit of a bigger stop, but you can set much further targets. And that trade management strategy, which I teach you in that 10-module course, how to do it on your own. Nobody ever talks about that, and nobody ever tells you what their trade management strategy is when they scale a trade or when they tell you they've made all this money. Well, how did they get in? What was their stop? What did they use to get out? That's the key to the trade. We tell you that because when we take a trade in the room, those targets just come right up off a chart trader, which is on. Now, if the market was open, I could show you a trade, but I can't do it because the markets are closed. Right now, Jeff, it only runs on Ninja. Ron, if I didn't tell you that this wasn't good on any time frame, on every market, then it's no good at all. There has to be a time frame independent strategy or it doesn't work. I mean, what you have to pretend is that this candle can be an 8-range candle, a 5-minute candle, a 4-hour candle, an 8-hour candle. It's irrelevant. The indicator signals are going to be the same. The only difference is going to be your stop and your targets. We have traders trading 4-hour bars, 8 daily bars, 8-hour bars. It makes absolutely no difference the speed of your chart. We have a lot of. I used to trade a tick chart, and I like them, but I'm become addicted now to range. But you can trade a 377, a 610 on the E-mini. You can trade 1,000 tick. It's irrelevant. If the system wasn't active and relevant and precise on every time frame, then it wouldn't be active or precise on any time frame. And I've seen systems where they tell you got to trade the NASDAQ at a 450 or you got to trade this at a certain speed. Obviously, those systems are broken because they have to be time frame independent and they've got to be instrument independent. And in fact, I didn't want to get into this. We have an automated system that trades bonds on a 3 range. It trades notes. I don't trade them. Our automated system does. It trades the 6E. It trades gold. We're in the process of putting it on the Dow. And it trades the NASDAQ. And it trades and these are all traded, automated, algorithmic, looking for the same signals I showed you. So it works on all these markets. I'm just going to push these back to where they were. I don't look at these charts. I can only handle 2 at a time. If I try to handle more than that, I go on information overload and I miss a lot of good entries. So we just put that on the automated system. And by the way, okay, I'll tell you that at the end. No problem, no problem. Oh man, Tom, if you would have come to us before you went there, I could have saved you that money. I'm so sorry about that. That guy, I'm not going to mention his name in the room because I don't like to diss anyone. You know who I'm talking about, but that's a sham, and I'm real sorry for you, Tom. He's got nothing but he's a voodoo guy, and I'm sorry. Okay, Tony, no problem. Yes. Eventually, Jeff, I trade Thinkorswim for my options. And I'm a very, very aggressive options trader. I just took, and I have an option. These are things I didn't really want to mention, but I have an options portfolio that I actually it's available. We just closed our most profitable option ever on Google. We made $10 a vertical spread. That's $1,000 for every spread we took. I've never made that much money on a single vertical spread. And we just closed it today on Google. We have spreads on Amazon right now, spreads on Apple. We closed out spreads on Facebook. I had a spread on Netflix. We closed out a spread today on Delta for about a 65% win. We've got a lot. I have Cypress Semiconductor. All of these were taken off the software. I wait for the signal and I take the trade. The killer for options is trading into consolidation or retracement. This system keeps you from doing that. I'm in Expedia. It really popped today. I'm in Tesla. It did great today. Cypress Semiconductor did good. I'm in Express Scripts and I'm down on that. I'm in iShares Biotechnology. I'm down on that. Walt Disney was one of my most saddest losers. We were way in the money, and then ESPN killed Walt Disney, and I have a killer on Qualcomm. So I have 2 losing positions, but we've got lots of winners. And today we close out a monster winner on Google and a real nice winner on Delta Airlines. And they're all traded off of this system. And we are going to trade code. But what I do is I take the trades off of Ninja, but I do my executions for options on Thinkorswim. You can't do them on Ninja, and they're cheapest, and you can trade options great on TOS. On Sierra, Tom, maybe in a week or 2. We're real close. Well, listen, Diana, just give us a call. No, Diana, you don't have to use range bars. You can use any kind of candle you like. It does not matter. If you're really wed to time or tick, you can use them. And I don't have a strong argument against trading tick because I traded tick bars for a long time. I like range bars because we have a range maker here on the right edge. It's kind of squashed on this chart, but I'll show it to you here. I already know where the close is going to be to the upside right now. If the E-mini candle goes to the upside, I know I'm going to be at 21.1450. To the downside, I'm going to be at 24.1225. So it's an easy trade for me to make. That's why I like range. But tick and time work real well. And if you really like them, it's no problem. Our indicators handle them fine. Whatever tick you put in, it's going to default to the closest fib and give you the 2 higher time frames. Time, it's going to give you 3 times your trading chart and then 3 times the higher time frame. So time and tick are done well, and a modified Renko can trade fine as well too. Well, Kate, that's the thing. You have to be patient. If you want to take the lowest risk trades, you have to wait to get all that alignment. And Kate makes a good point. She says, well, how often do you get all those lines green or all those lines red? And the honest answer is this: not often. But let me ask you a question. How many times in the course of a week does the market need to align that way for you to make $1,000 to $1,500 a week on a very small amount of money? It's very few times. I mean, if you trade 2 contracts or 4 contracts in the futures market and you take 4 to 6 trades, and let's just say for argument's sake, everything's green and it's a perfect trade and you get 6 winners, you have $1,500. That's the point. You have to be a patient trader and you have to take the trades that are the lowest risk, highest reward trades. If you do that, you shouldn't have many trades in a week. And you shouldn't expect to get those kind of handy back up the truck to the bank trades very often, but they happen. And when they do, just don't miss them. Don't miss this short trade here. Don't miss this strategy entry. If you miss them, you know, your fingers aren't going to fall off. But when a good trade comes, you've got to jump on it without hesitation. You've got multi-time frame momentum and order flow. I'm sure the delta was with you. Background bias is with you. The 15's crossed the 50 to the downside. The 50 is rolling. You've got a retracement back to resistance. This is a short trade off of a smart indicator. You're into the downside, and you've got yourself a great trade. You don't need many of these in a week. That's a 20-tick trade. If you're in that with 4 contracts, you make $400 on that trade. I mean, how many do you want? That's the point. If you want to take higher risk trades, you can always do it. But why bother? Is really the point. The hallmark of a lousy day trader is they churn their portfolio. They take 5, 6, 7 trades a day. They're up, they're down, they're up, they're down, because the trades they take, sometimes they win, sometimes they lose. You take your low risk entries, you hit your profit target, and you're out of the market. If you come back later and you see you missed a great entry, you know what? Forget about it. Forget about it, because the point is, a great entry doesn't necessarily have to work. And that's the whole point of trading. If 80% of your great trades are winners and 20% are losers, it's an amazingly high predictive value, positive predictive value. But still, if you trade pop perfectly, 1 out of 5 trades are going to blow up in your face. Don't risk it once you've made nice money in the course of a day. Close the platform. That's what I do. It's the only way I can stop from trading. Is I tell the room I'm closing it, and I close my trader, and I'm out. I don't want to look at the market anymore, because it always like sucks me back, and I don't want to do that. It's all lifetime, John. Everything. Everything's alarmed. Yes, Brian. You can alarm the whole system. I don't like to activate my alarms, but every single indicator comes with an alarm. And I'll show you the strategy indicator. You know, we may not have one on the strategy. We have one on the ABC, and we have one on the, I'll show you the ABC. And we'll alarm it for you, because that's really easy. Let me find it here. There's your sound file. There's your ABC alert. Almost every indicator we have audible alerts on them. You know what the problem that I have is? I have so many automated systems up, like bonds and notes and gold and the NASDAQ and the Dow. And if I have these set to audible, I get your pop. It's like beep, 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 beep all the time. If I'm staring at my chart and I'm focused on these 2 that I trade, these are my money charts, my Crude and my E-mini, I don't need a beep. I'm going to see that trade mature, and I'm going to be on that trade. And I'm going to have that buy stop or sell stop in long before the candle matures. I'm going to be in the trade. I'm not going to mess around. But if you want the audible alert, if we don't have it on a signal, we'll put it there for you. No problem with that. We already have a wave file on the ABC. I think we have a wave file on consolidation. We don't have it on the strategy. We'll put that in. It's really easy. The triangle items, Brian, those are the signals out of consolidation. And it's always a mystery to traders when to trade out of consolidation. The mystery is gone here. You're not, now that's a consolidation signal that fails. And this background bias is not the best. Its bias is definitely short. You don't have the quant line, in other words, the correlative markets with you. But I would have taken that trade, and that's a loser. I'm not going to kid you, and I'm not going to try to tell you, okay, you take this blindly. Our algorithmic system takes losers, but that's a trade out of consolidation. But most of the trades, the vast majority of them, are great entries. And always when you look for one, you can't find them. See, here's one right here. Whoops. Let me move that out of the way. Right here is a triangle, and that's a trade out of consolidation. And I actually took the trade a candle too early. On the C, it came back 6. My stop was 7. Actually came back 5 on me and formed and moved out of consolidation and then fired up. I didn't take the C, and I could have for another 2 because I felt that the market had just moved too far. But you see, it went up another 2 off the C, off support. And I didn't I didn't phony it for you and tell you I took this trade again. I did not take that trade. But that was another winner, another fairly modest winner. But we had hit our profit target. I didn't want to trade again. And I saw the C. We had multi-time frame order flow, multi-time frame momentum. Background bias was perfect, trading right off support. I didn't have that first quant, which was one independent variable that I would have liked on the trade. And I had already hit a nice profit for the day. But you could see this was a pretty low-risk trade. It went for 2 points. And I just let it go. And then, if you would have traded that over my shoulder and taken it, it would have been a great trade. Yeah, normally, Ted, you're right. I mean, $7.99 is just for normally it's just for market profile. If you want a market profile that provides you with a footprint and a market delta, I don't know any that provide you with multi-time frame order flow assessment. That's $7.99. It's a very complicated indicator. This stores volume data, which makes it very difficult. It took us a long time to code it and get it perfect. And it gives you a footprint. It leverages volume for you in every way possible. But in the special, you're also in the room for 3 months, and I'm going to teach you how to trade. Now, I'll show you one other special, which I didn't want to mention, but it's running through Sunday. We're on Ninja 7, Bill. We're going to be on Ninja 8 in really just a week. So if you program it for Ninja 7, you'll be moving over to 8 really shortly. I mentioned that already, Brian, about getting out. We already have our automated trade management strategy programmed for every instrument we trade. It's already programmed in. As soon as the trade ticks in, our stop automatically sets up, all our profit targets set up, and that's when you sit and leave the trade alone. Just let it run. Once you hit your first target and move a couple of ticks, we're on a runner. And we try to lock in as much profit as we can if the trade comes back. And the runner, the size of the runner is also determined by the stuttering of the market, by the average true range. We try to milk a trade as much as we can. It's really important because the important thing about milking a trade is you want to get out of the market. I mean, if you take this trade and make 8 cents on it, you're still in the game, and you still have to take another trade. If you get this trade and you make $250 on it, then maybe you're done because you took one other trade. So milk it for all you can and get the heck out. Hit your profit target and close up. That's the hallmark of a professional trader, and that's how you slowly move up to that $1,000 mark in a week, or 2,000 or 3,000, depending upon how many contracts. And I'll just tell you this, it is never about the number of winners you take. It is always about the number of losers. If you can take only 1 or 2 losers in a week, you only need a very small number of winners to make great money. So it's never worry about getting a great entry. They will come if you just wait. Worry about avoiding the losers. That's what our system is set to do for you, to tell you that your risk is too great on the trade, and the best thing to do is stand aside. Don't take risk, and that will make you a profitable trader. Charles, the Forex does still, though, have a bid-ask side. I mean, there is a spread, but there is always a bid-ask. I mean, if I move this to, I don't have a Forex data feed, but there would always be certain traders on this side and certain traders on this side. So you can make this assessment on the Forex markets. You can see whether there's buy-sell pressure on the Forex markets just by looking at how many traders are sitting on one side versus how many are sitting on the other. Remember, the Forex analysis, critical to getting a great trade on the Forex is assessing volume, and the volume on the Forex is what determines the spread. If your volume is high, then the spread between the bid and the ask narrows. And when the spread when volume is awful, the bid and the ask widens. So there is a bid ask on the Forex, and you can assess it with the market delta. You're right, Dennis. I looked at the wrong side, and I realized that afterwards. But the point I was making was still valid. That's all. Smart guy, really. Brian, unfortunately, we don't take PayPal because they were charging us so much for a transaction. We just take Visa, MasterCard, whatever. You can send us a check. It doesn't make any difference. Here's what we do, Brian. On an 8 range, we have determined to take a 10-tick stop. On a 5 range, we take a 7-tick stop. But we do a very, very tricky thing, and I'll show you what it is if you hang on 1 second. And I'm really so far overboard on what I wanted to show you. And this is how we really limit our losses and pull that stop away from our maximum really quickly. You know, I can't show you because the market's not open, but if the trade goes 1 tick in our direction, now a normal platform will not do this, but what we have is an NDT trade execution thing. We created our own trade execution platform. I don't trade off the dome. We have our own proprietary system that has a patent pending. And that allows us, so let's say the trade goes a tick in your direction. It pulls the stop a tick in your direction. If it goes 2 ticks in your direction, it pulls the stop up 2. So, and if the only time you're going to take a full loss, if the trade ticks you in, it comes right back against you. And every now and then it's going to happen. I'm not going to kid you, especially on crude, which is a choppy market. But if it pulls the stop down, you're only going to take a partial loss. And what we're doing is we're looking to maximize our winners and to minimize our losers when a trade stops us out. That's all we're looking to do. Initial stop is 10. If the trade goes 2, our maximum stop is 8. If it goes 3, maximum stop is 7. If it goes 4, stop is 6. If it goes 5, we got our first target. And we've locked in profit, and it stops at break even. So we do everything we can to get profitable. Thank you, John. I know. Great, great, great. Thank you, Diana. Very good. You know, I'll tell you what, John, we have so many templates, but what we always do, just out of courtesy, is if you want us to make a template for you, we'll make it. Like we just had a guy ask us to make him a whole bunch of 3-minute templates, and we make them for you. We don't have any problem with that. I mean, we have Sergio here. He's he's not a winemaker. He's a template maker. So you can see how many templates we have. We also have 12 Forex pair quant lines looking at the flow of institutional money. And we've got multiple stock quants. And I'll just tell you, I'm going to let you in on a secret. It's not so much of a secret. Listen, Diana, I traded the Forex a long time. You're going to get great Forex entries. If I had the time, I would put on my FXCM data feed and I would show you my 12 Forex players. They look exactly like this. You could trade the DAX on this system. The DAX trades great. I just can't get up at 2 o'clock in the morning. You can trade tick charts, Diana, no problem. I do only because I like to throw my money at options. But let me tell you, the net equity that people make are exactly what we do. Exactly, because we have preset targets. I mean, you know, we don't play around with our stops and our targets. If they hit, they hit, and everybody's in. Yes, Brian, we will always program the trade management in for you no matter what you buy. For the $7.99, we will put the ATM strategy in for you. Thank you. Okay. Thank you, guys. Thank you, guys. What order flow you use for Forex? All we use for Forex is just listen. It's just the bid-ask imbalance. That's all the Forex is. There's always traders on the bid. There's always traders on the ask, even on the Forex markets. And on the Forex markets, we're just looking at the bid-ask imbalance. That is all order flow is. And we create a moving average of that bid-ask imbalance. And that can be done on any market. You must have a bid-ask imbalance because volume is what determines the Forex spread. You know, sometimes it's a pip and sometimes it's 3 pips. And I'll tell you this, what we have done is we have found that it's impossible to automate. You know you have all these Forex engines and they're going to give you 100,000 pips. The reason why you can't automate a Forex system is because you can either optimize for the bid or optimize for the ask, but you can't optimize for the actual entry price. So we spent months trying to optimize a Forex system, but a real Forex entry system that's automated cannot work because you either optimize on the bid side, either optimize the ask side, but that's never the actual entry. So if the bid-ask disparity is wide and your entry is a tick or two off your bid or a tick or two off your ask, the automated system blows up in your face. So all these systems that tell you they have automated Forex don't work because they can't optimize for the price because they don't know the entry price. And you can't optimize for an unknown quantity. So they're all fake. And I'm just going to tell you one more thing. I love the TF, Jeff. The problem with the Russell is that since it's been on the ice, it's died in volume. And I just don't like to trade an instrument that has 50,000 contracts or 75. When it comes back to the CME, which it's going to do, we're going to trade it. And I'm going to tell you something that we're going to do. And we're in the process of working on it. And it's only going to be good for the index equities. These lines, and this is way beyond volume profile, this line assesses our tightest correlative markets. These 3 markets have a correlation coefficient of 0.9. So they're going to move in the same direction as the E-mini 90% of the time. These markets have a lower correlation coefficient. And this is our intermediate quant. But these are all futures markets. What we're going to do, and it's really going to be, I hope it works because it's all experimental. we're going to bring in the cash markets via the use of kinetic. And we're going to create cash quants on the futures markets. So, because it's my gut feeling that if the E-mini cash market is upticking, you're more likely to get a better trade on the futures market. If the E-mini is more likely on up volume, you're more likely to get a better trade. If the E-mini has certain particular sectors, big sectors, that are also upticking, you're also more likely to get a long trade on the futures markets. So what we're going to do is we're going to bring in cash metrics and look for them to correlate on the futures market to optimize our entries to get an even better long trade. It's all experimental. I don't know if it's going to work. We're going to do it, but we have to see over 2 years if it actually increases the predictive value of an entry. But that's our goal, is for us to have 2 more lines for 6 more correlative markets looking at S&P 500 cash metrics. And that's our biggest experiment now. If it works on the S&P, we're going to do it on the Dow, we're going to do it on the NASDAQ, and we're going to do it on the Russell. And so it will work on all those. There's no cash equivalent of crude or you know, bonds and notes, but there are cash equivalents of these markets, and we're going to use them. We're going to look at mid-cap markets, cash markets, to drive the E-mini S&P. And I think it's going to give us an amazing heads up on everybody else who trades. So it's $7.98. I'll just tell you what our offer. I'll just tell you the offer because some people may be interested. And if you bought the $7.98, you can upgrade. The entire system right now is $27.50. That's every indicator. You have to call us because we don't have a link. It includes the one you bought. We already had 4 people buy. So if you want the market profile, the 3 months in the room, and the 3 months of on the 10 modules, this is just a fraction of what I teach. But if you want all that, including the entire system, every indicator, and what we always do is always give upgrades. If we add something on, you always get it for life. It's just everything for $27.50. And normally it's $3.90. It's $3.99 for the software alone. So you still get the 3 months in the room, and we add to that our trade execution platform. And if you give me 1 second, I'll show it to you. It's an amazing tool. I would never trade without it. It's such a tremendous disadvantage. If you give me 1 second, I wasn't going to put it up, but I'll put it up. Let me just go to strategies and turn it on real quickly. Sergio usually does this, and so I'm kind of a retard on it. Let me see if it comes up now. It's not coming up yet. Give me 1 second. It should come up in a second. There it comes. This is our execution platform, and this comes with the software. So let's say you're on a tick chart. Diane, you said you like to trade a tick chart. Well, at the close of the tick chart, you don't know the price that's going to close. It's impossible to know. So let's say you want to go long at the close of a tick candle. You simply buy an up close, and the system is going to get you in at exactly the price it closes at plus a tick. Or you want to sell a down close. Now you hit that button. You don't have to care what the price is. And this is all patent pending. And a lot of also people say that it's patent. We have a patent waiting for 2.5 years on this system. And here's how we get out of trades more with less of a loser. If you take a long trade and you get a reversal candle, the trade's going to blow up on you. So if you, as soon as we go long, we hit close on a down close. I can't do it because we're not in a trade. That means if the trade comes back and creates a down candle against our long trade, it's going to take us out of the trade with a lot smaller loss. And these are the staples I use, and I never worry about the entry price. I don't have to chase it. If you trade ticker time, this is awesome tool. And I'll show you one other thing that we do on the E-mini. You see the E-mini is set for a 1. That means what we do on the ES is we actually, I don't want to defend anyone. We try to screw the market out of a tick. So let's say our entry is the C candle right here. Our execution or our trigger is 1 tick above. But that doesn't get us into the trade. What gets us into the trade is the candle that has to shoot out a 1 tick wick, and it gets us in the trade already up a tick. So we get it. We need a 1 tick pullback. So when we're in the tick and move back to that +1, we're already up a tick. So when we go 3, we're already in a profit of 4, and our stop, which is 7, now becomes 6. Now occasionally we don't get the wick. We don't get the wick, we don't get the trade. And I call that an NP, a no pullback. But it provides us with a huge premium in every trade. And if you see the way the E-mini moves, almost every candle shoots out a wick. It's just the way the E-mini moves. And they almost all shoot a 2 tick wick, which guarantees you're going to get a pullback on a 1 tick pullback. And this is what we use. And you get that for life with the 2750 if you want to buy the system. So that's what we got. I mean, we've been working for 3.5 years on it constantly, and we're constantly upgrading it. Our next step are the cash quants on the futures market. And if it works, we're going to trade the cash markets with the futures metrics. We're going to reverse them to try to give us a better opportunity to get a winner on a stock. But I think it's going to be more applicable to the futures markets, where we trade the E-mini S&P as a basket of 500 stocks. So that's it. I really appreciate everyone's patience. Charles, what we're going to do is we're going to contact you. We're going to ask you for your NinjaTrader ID number. And then Sergio is going to call you tomorrow morning, set up a time with you, and he's going to configure it for you. So do not worry about that. We don't send it to you in a zip file. We do send it to you in a zip file, and you're going to get it. But we almost always do the configuration for you, because since it's a complex system, we want to make sure it's working perfectly. So he'll sign onto your computer and do it, but you are going to get a zip file. But the first thing you need to do is just send us your NinjaTrader ID number. You're going to get an email to that effect very shortly, and then as soon as you do, you're going to get the package. So don't worry about that. So we have 4 down. We have 1 to go on the full package. If you want the whole program for $27.50, you can give us a call. Everything is lifetime. I mean, I don't believe ethically that we want to charge you for a dime more if you come and become a part of our family. You get all the upgrades, all the add-ons, and all that stuff free of charge. If we make a new indicator, you get it. We just recently upgraded the market profile. We're going to be giving it out very shortly. We're going to be upgrading market profile again, and that we're going to be changing the color of this volume profile in a very, very unique way to help us trade. And that's going to be in our 3.0 version. So we're constantly trying to give our traders an edge to make money in the market. And that's it. So listen, have a really, really wonderful afternoon. This is going to be on a link, and you can cut it off when the questions start if you don't want to listen to it again. But I hope to see everyone in the room, because my goal every day is to make us money. And I am not a flim-flam guy. Like, I'm a really nice guy in the room, bought a program for $3,500. And what he got out of it was 0, because he got finagled. I trade the right edge every day with this system. and it puts up our trade management strategy. You see every target, everything is out in the open. You see our profit loss up here. Every second we're trading. So it's all in there, and we don't hide anything. When we have a wart, you see it. And when a hair grows out of the wart, you see that too. We don't hide anything at all. So I'm always on the bubble to trade well. So have a great evening, and no matter what you do, I wish everybody the best of luck. Sure, Dan. Thank you very much. Have a great afternoon for everyone. Thank you all. Bye-bye.